The wealthy do not avoid debt, they weaponize it. Leverage is the strategic use of borrowed capital to increase the potential return of an investment. The fundamental distinction between good and bad debt rests entirely on the asset acquired and its cash flow profile. Good debt finances assets that generate income or appreciate faster than the interest rate charged. Bad debt finances liabilities that depreciate rapidly or provide zero financial return, such as credit card balances for consumer goods. Understanding this mechanism transforms debt from a liability into an accelerator. When your return on invested capital, the ROIC, consistently exceeds the cost of borrowing, the interest rate, you are effectively using the bank's money to build your equity. This is the core principle of wealth creation through leverage. Consumer debt is the primary wealth destroyer. Credit card interest rates frequently exceed 20% annually, guaranteeing that the cost of capital far outstrips any potential utility derived from the purchase. Financing depreciating assets like new cars or electronics through high-interest personal loans locks the borrower into a negative equity position immediately. A car loan, for example, funds an asset that loses 20% of its value the moment it leaves the lot. This debt structure ensures the principal balance remains high, while the underlying collateral value declines, creating a perpetual drag on net worth. Avoiding high-interest, non-productive debt is the prerequisite for any successful financial strategy. Real estate mortgages exemplify good debt because they finance appreciating, income-producing assets. A standard 30-year fixed-rate mortgage allows an investor to control a $100,000 asset with only $20,000 of their own capital. If the property appreciates by 5% annually, the investor earns $5,000 on the entire asset value, not just the $20,000 invested. This magnification of returns is the power of leverage. Furthermore, investment properties generate rental income, which covers the principal, interest, taxes, and insurance, often resulting in positive monthly cash flow. The tenant effectively pays down the investor's debt, increasing equity passively. The loan-to-value ratio, or LTV, determines the risk profile and required equity injection for real estate financing. Lenders typically prefer LTVs below 80% for conventional mortgages. A lower LTV reduces the interest expense and increases the cash flow margin. Analyzing the debt service coverage ratio, or DSCR, is crucial for investment properties. The DSCR must be greater than 1.0, meaning the net operating income exceeds the required debt payments. A DSCR of 1.25 is a common benchmark for lender approval, ensuring a 25% buffer against unexpected vacancies or maintenance costs. Maximizing leverage while maintaining a healthy DSCR is the balancing act of successful real estate investment.
Debt is also a powerful tool for scaling profitable businesses or leveraging diversified investment portfolios. A business loan used to purchase specialized equipment or expand production capacity directly increases revenue generation. If the new equipment generates 20% return on assets, but the loan costs only 7%, the 13% difference is pure profit accelerated by leverage. Similarly, strategic use of margin loans and brokerage accounts allows investors to purchase additional securities, provided the expected market return significantly exceeds the margin interest rate. However, margin debt carries substantial risk, as market declines can trigger margin calls, forcing immediate liquidation at unfavorable prices. The decision to utilize debt must always hinge on the comparison between the return on invested capital and the cost of capital. If the expected ROIC is 10% and the interest rate is 6%, the 4% spread is the positive leverage benefit. This spread is amplified across the entire borrowed principal. Conversely, negative leverage occurs when the cost of capital exceeds the return, immediately eroding both. Investors must calculate the weighted average cost of capital, incorporating all fees and origination costs, to determine the true hurdle rate for any leveraged investment. Never borrow money unless the investment thesis demonstrates a high probability of exceeding this true cost. Tax codes often incentivize good debt through interest deductibility. In the United States, mortgage interest on primary residences up to a certain limit is deductible, reducing taxable income. More significantly, interest paid on debt used to acquire investment assets, such as rental properties or business assets, is typically fully deductible against the income generated by those assets. This tax shield effectively lowers the true after-tax cost of borrowing, widening the positive leverage spread. However, interest on personal consumer debt, including credit cards and car loans, is generally not deductible, further cementing its status as financially detrimental. Leverage magnifies returns, but it equally magnifies losses. Effective risk management requires maintaining adequate liquidity to service debt payments during periods of low income or market volatility. Business loans often include financial covenants, such as maintaining a minimum debt-to-equity ratio or specific cash reserves. Breaching these covenants can trigger default, even if payments are current. Real estate investors must stress test their cash flow models against rising interest rates or extended vacancies. Over-leveraging, where debt service consumes too much operating income, is the fastest path to financial distress, regardless of the asset quality. Strategic debt utilization is not about avoiding borrowing entirely. It is about disciplined allocation of capital toward productive assets. Successful wealth builders treat debt as a tool for acceleration, not consumption. Focus exclusively on acquiring assets where the expected return reliably surpasses the after-tax cost of borrowing. By consistently applying the principle of positive leverage, you shift from trading time for money to having capital work for you, significantly shortening the timeline required to achieve financial independence. Master the difference between funding a liability and financing an asset, and debt becomes your most powerful financial ally.